What's going on, everyone? Good morning. I'm sure everyone here is having a good day. If you took some of those earnings trades yesterday, it's nice to see the season kicking off with a good start here. There's nothing better than a couple pancakes in the morning, am I right, boys? So, we're going to give it a moment here for some people to trickle into the stream. I've shared the link in a couple groups that I'm a part of. Shout out to Hallett. Hopefully he'll be able to come check out the stream. Shared it in Hallett's group. So we're going to have a few people joining us, hopefully, who are not from Predicting Alpha. So we're going to do a pretty open conversation about earnings here. To kick it off, yesterday was a big day for earnings. We had JBLU, we had Tesla. I believe there was a couple others taken in the group. Let me go check here. That were pretty good. Let's see what they did here. Trade summaries. Vail looked okay. Where JBLU, what was the one that Hutch took? Hutch took one that he said was pretty good. Hutch is our in-house earnings champion, PHM, right? And so I want to start this off by having a conversation about what really is going on around earnings, right? Earnings events drive a ton of volatility, okay? 30 to 70% of how much stock moves in a year can actually be attributed to 4 earnings events. 4 days in the year driving 30 to 70% of a stock's volatility. And the cool thing about the options market is an option, volatility is synthetic time. And what that means is we can actually go in and look at the option and evaluate what the market is implying to happen around an earnings event, right? You know, a lot of people will just look at the IV, but we can actually go a level deeper and extract the earnings move from the IV. So for example, if we come here to Tesla, hopefully it hasn't changed yet. Ah, shoot. There's no earnings move there. That's too bad. Here, wait. Hold up. Maybe I need to reload the terminal. Just give me 1 second. Yeah, we were looking at Tesla as an example yesterday, right? And I was having a conversation where someone was saying, you know, Tesla vol is looking cheap around the earnings event. And I was trying to talk to them about it and say, well, how do you know that it's looking cheap, right? How do you actually know that earnings is cheap around Tesla? And they're like, well, the IV is lower here. Why isn't Tesla populating there? Maybe because it's already happened. Let's see if we go to CRE. Okay, yeah. So I came into the terminal. I said, well, have a look at this, right? And Tesla was implying about a 7% move around earnings, which is what it usually does. So even though the IV was lower on the options, the implied move for the earnings event was the same. So what we like to do is we come in. So where everyone else was thinking that Tesla vol was looking cheap, we were thinking it's either fair value or a little on the expensive side. So while a lot of people on Wall Street Bets and you know our options would be sitting there saying, I'm buying options going into this event, what really would have paid out is if you had sold options. The stock opened up, right? If we go to 930 here, it opened up down between 2.8 and 4%. Meaning if you sold those options yesterday, you made an absolute killing. An absolute killing trading the earnings event. So what I'm going to be showing you today, guys, and we're going to go over a couple examples. Tim, I think you posted some stuff in the group. It was either you or Run. Yeah, we got a couple here that we want to look at. A couple events here that one of our members wants me to break down with them. And what we're going to be doing is pricing out the move around earnings. Trading has always been the same thing. It's always been about buying cheap and selling expensive. Right? If you can find a $5 bill that someone's willing to give you for $3, it's a no-brainer to buy it. If you can find if you have a $5 bill that someone's willing to pay you $10 for, it's a no-brainer to sell it. And this is the thing that's been missing from the retail space for a very long time. It's the reason why most traders don't understand why someone would buy a Bloomberg terminal. Right? Why the heck would somebody spend $50,000 a year on data? And it's because we haven't been taught to think about taught to price the asset. Right? We've been told that we just have to look at the chart and we'll be able to make money. When in reality, the winners of this game are playing very differently. They are sitting there saying, what is this thing really worth? It's always been that way. It's a trade. Right? If you thought about a trade in real life, it would be about what's this thing worth versus where I can maybe sell it for a different value somewhere else. It's always what it's been about. So for this live, we're going to be focusing on those earnings events, and we're going to be trying to price out that move, see what we think it's really worth, and whether we should be buying or selling volatility going into these events. So we have a couple recommendations from our buddy Lord Runcorn of the Rattlin Bog. I don't know, he's a weird guy. But we're going to look at these three names today. Let's start off with SIRI. What is this actually? Sirius, okay. Okay, this looks great. This looks great. So let's break this down. Now, when you want to price something, the first thing you need to do is have a benchmark, right? Well, or you need to be able to understand what the market is showing you. Something is mispriced when you disagree with the market. So we can see here the market for Siri, which has earnings, it looks like tomorrow before market, I'm assuming. Let's come and check. Tomorrow before market. Yeah, so you can see time of day, BO. And we can see that it's confirmed for April 28th here. The market is saying we expect Siri to move 5.28% up or down on their earnings day. That's what we're expecting. And this is not a directional move that they're saying. It's just up or down. It's a range that they expect it to stay within, right? One of the things about options, remember, it's a volatility product. We're analyzing the size of moves here, not necessarily the direction. And okay, so now we have our benchmark, right? The market's saying, I'll give it to you for $5. Okay. Well, now we need to determine what do we think it's worth. And we're going to use a couple different metrics for that. First up, maybe it's worth asking ourselves, okay, you're saying it's going to move 5%. Well, earnings happen all the time. How does it usually move? And what we see here is if we look at the last 4 years of earnings, that's 16 events. On average, Siri moves 2.79%. Nowhere near the 5.28 that the market is saying. Right? So, market saying this thing's worth $5. We're saying, well, it's usually only ever realized a value of $2.79. Right? Obviously, we're talking about percent moves here, not dollars, but just trying to make it understandable. So off the bat, I'm thinking, wow, maybe this is looking a little pricey. Right? Maybe options are expensive here because that move that's baked into them is so high. Well, there's a key question we want to ask ourselves too, right? What if this is a unique event? What if usually the market says it'll move 2 and it moves 2.79, but on this event, it's saying it's going to move 5. Maybe there's something special about this event. Somebody maybe knows something and is bidding up the options. Maybe there's some insider trading. Maybe there's more risk around this earnings event. Well, what we can use as a metric of is this an anomaly or an average event is, well, how does the market price it on average? We know how much it moves on average. We know what the market's saying right now. But does the market usually say this? Are they usually overstating it? So we have this next number here, which is the average implied move. Now the average implied move is the market implies something every earnings event. What is it saying on average? And we can see that on average, it's actually saying about the same, 5.11%. So it's no surprise to us that it's saying 5.28%. It's just maybe indicating to us that if it's usually saying it's 5% and it's usually moving 2.5%, maybe the market is just systematically getting it wrong here. They're just overstating vol on average here. And maybe this is a good selling opportunity. So off the bat, that's what I'm thinking here. Good selling opportunity. Now, what we might want to do as well is take a look at each event individually. Right? I hope you guys are starting to see, right? For the new people on the stream here, just a quick reminder, my name's Sean, co-founder of Predicting Alpha. We've basically built the best option of volatility software that's out there. It gives you all the data insights you need to actually price an asset, find real market inefficiencies, and then we have a community and a bunch of education that teaches you what to do with it. So this here is the implied move, right? This number here for each event individually historically. Here's how much it actually moved over the course of the day. And here's how much it moved right at the start of the day, right? So like when the market opened, the stock usually jumps after earnings. That's what that red bar is. So let's look at the jump and the move here. And we can see that it's basically always overstated it. It's always overstated the jump. And that's why when we look at this strategy P&L here, right? This is long straddle, long call, long put. We can see that being long the straddle is just been terrible. It's been a bad game. What does this mean? It means that if we had taken the other side of this trade, our P&L would be huge. Over the last 4 years, you would have done 215% selling volatility around Siri earnings. We can look at it for the calls and for the puts as well, but I'm not seeing anything too special there. Earnings distribution, market's basically saying this is the thing to remember about options, right? Is they imply a distribution of potential. Right? When we look at this, the market, it implies a probability of different sized moves. And that's what this blue graph shows us here for Siri earnings. Oh, is it a super cheap stock? Runcorn, you've set me up for failure here, my friend. I'm gonna have words with you. Well, we'll see what we can price the straddle out at. It might not be worth it then to actually take it if it's too cheap. Bastian, thank you. I put too much faith in Rob here. He got me. We'll still finish our analysis though. Right, this implied move here. This is what the market's implied distribution is for this current event. But here's what we actually see. We see that we get these smaller moves with significantly higher frequency than the big moves. Significantly higher frequency. Right? And this indicates to us that, once again, maybe things are overpriced here. Right? Think about it. If things were fairly priced, we would see a distribution similar to the blue one. But we're seeing it so much more condensed into like the small move range. So that is a couple of the key points that I would look at to break down an earnings event here. Right? And this is sort of how I look at all earnings. I'm trying to price the move. It's always been like that. And we've just found a few different factors that help us determine if the move is cheap or expensive around an earnings event. So how do you run that as a strategy? Well, here's the cool thing about earnings, right? Let's come in here and let's look at today. Today's what, the 27th? Let's look at 27th. Let's just look after market. We have 36 potential earnings events after market today. And it's not including the ones that are tomorrow before open. There's probably 50 events for us to look at today. So doing all this work gives us a small advantage over the market when it comes to earnings. Yeah, so Dante's asking, how does it being a $6 stock affect this trade? Does it have less liquidity? So it could be a liquidity factor, but it's also, so liquidity would definitely be a big one, but you're also not collecting much premium here. Right, you still have to pay your cost of transaction. You still have to cross the bid ask. You still have to, you're, and with an edge, this actually looks like it has a decent bit of edge, but usually there's not much edge. Right, and when there's not much edge, paying a penny here and a penny here, and then 50 cents for the contract and all this, what are you left with? A penny of edge? It sometimes makes it negative expectancy in the long run, right? So that would really be why it being a $6 stock affects the trade. I usually like to look for ones that are usually over like $15. But small account challenge. If if someone's trading a small account, maybe you take a little punt here. You sell some vol and you see what happens. Let's go true. Right, you see we got 31 events here to look at that are confirmed for tomorrow. All right, let's take a look at what's next from Runcorn here. I swear to God, if he, I'm checking this one. Let's see. No problem, Dante. Good to see you here, man. Thanks for coming. So, all right. Rob didn't screw us this time. It's liquid. It's got a good price. I wish he was here. I like having good banter with Rob. And it's today after the close. FireEye Incorporated. So let's do another analysis here. Oh, this is looking juicy, guys. It's looking like another one that might make the cut. So, implied move, market is saying the stock is going to move 7.18% today after hours till tomorrow. That's what the market's implying for the earnings. We see it has an average move of about 6.66%. 666, the devil's number. You know that we're going to be making some money on this trade. And then we got an average implied move of 9.8 here. So this is something interesting, right? We're seeing markets basically usually saying this thing's going to move 10%, but right now it's saying that it's going to move about 7%. So it's come down a good bit, and it might be worth doing some digging to figure out why, right? Why is the market thinking vol is going to be more mute here than what it usually is? Right? Maybe they've pre-released in some way, and a few people are already selling vol going into this, or market's pricing in less of a move now. Some numbers coming out. This is market saying that there's less chance of a big move. It's pricing in less, and that can be a good or a bad thing. The reason I think it's a good thing is market is pretty efficient. Right? If the move's coming down like that, it's probably a good sign. Now, something we see here is historically they have had a few big movers. Right? It used to move a ton. And now it looks like it's calming down a little bit. Right? And especially if we look at the jump here, the last few events have been huge winners. But you do have some blowout risk here, right? And this is the thing to always remember about earnings trading. You're going to have a lot of small winners. And then you're going to have the occasional, earth-shattering loser. And where people get caught slipping when trading earnings is when they go too big. They bet too big, and it goes great for a long time, and then they blow up. All right, let's think about this. On this event here, right? If you sold vol here, let's say you would have collected, let's say you sold $1,000 worth of premium. You would have woken up down negative $2,500 the next day on this event. It would have been brutal, right? If you had a $3,000 account, first thing you're like, oh man, I'm gonna make a ton of money tomorrow. Make 30% of my account, and you wake up with zero, right? So you need to size your bets appropriately. Think about it like a casino, right? If you go into a casino. Let's say the casino has a bankroll of $1 million. Let's say you sit down to play roulette. If you went in and you put down $1 million chip on black, you would have a 48% chance of wiping out the casino. Even though the casino has a winning game, if they let you walk in and they took $1 million bet on a game of blackjack or on a game of roulette, they risk losing it all. Right? So We need to keep that in mind. The casino would never, ever, ever let you do it. And if you were the gambler, you would want to do it, right? Because you have negative expectancy. The blackjack dealer has positive expectancy. He wants you to bet small and bet 1,000,000 times. He wants you to place 1,000,000 individual bets, whereas you would want to go in and place one big one. If you went in and place 1,000,000 small, if you bet that entire $1,000,000 $1 at a time, you can be damn sure the casino's walking away with every penny you have. And this is called expectancy. It's your expected value. Now, using this type of data, running earnings this way, you have that positive expectancy in the long run. But that's only if you live to see it. So super important to keep that in mind. Right? And we have, for example, seen some blowouts on this event here. Now, I'd say, it's probably okay for this one. It's probably okay. Right? 7% is still a big implied move. I think I'd be taking it. But it's that sizing. I can't stress it enough. Right? You gotta size appropriately on these. All right. One more. JNPR. Nice, Eric. JNPR. Did you get filled on that fly there, Eric? Implied move 4.69, average move 4.81, average implied move 5.49. So before I get into this, Bastian's asking, how much would you say is the max to risk on an earnings trade in percent of portfolio? So Bastian, there's a couple things here that I think are important. So it really depends on your account size as well. So for example, if you're trading, a really big account, you would want to trade like maybe 1% risk to 3% risk on a trade. And that's in like a blowout situation. Because there's so many events, you could do like, 20, 30% a quarter pretty reasonably. Like you could actually do it. And over a year, like that just compounds out like in unheard of numbers. Like numbers that only the gurus on Instagram will tell you can achieve. And we all know that that's BS. So if your account's at 30K, I would say you want to be risking maybe 3%, right? So you'd want to be taking on maybe 1K, 1.5K risk per trade. And Bastian, using this, if you do end up following this pretty tightly, a lot of guys in the group are going to be doing it too. We can have a lot of conversations about this for each individual trade. But then something to think about, I'm just going to mention it for guys here who maybe have a smaller account. Let's say your account's $1,000, right? There's a couple different ways you can play it. Now, what I think would be a big mistake is to, try and like scalp or something like that. And the reason is your commissions are going to kill you, right? Like anyone who's traded a small account here knows and is serious about this game knows the impact of commissions. So you don't want to be that guy. You don't want to be getting screwed on commissions over here. Besides that, I'd be doing 1 to 3% risk for you, Bastian. If someone has a really, really, or like a significantly smaller account, you maybe take on more risk. And the reason it's okay to take on more risk is if you blow up, it's one paycheck. It's not the end of the world. You know what I mean? It's not like, death, for lack of a better word. But also, if I had a $1,000 account right now, I'd probably be trading PA flies. Maybe like the occasional earnings, but where I just punt it. But probably PA flies would be my go-to. So yeah, Juniper, I'm not seeing a ton of edge here. It looks like things have calmed down recently, though. You know what? Honestly, this is one that I would ask some of the earnings boys about. This one's like really on the fence here. Really on the fence about it. Micah, look at this. 8% of the time, we're getting a 6% down move. Huh? Have you and Eric started working on this yet, or what's the deal? I need the alpha. Give me the alpha, Micah. Same thing here with Spotify. Frequent little down moves. Do we have any put skew here? Oh, damn it. No put skew. Yeah, this looks all right. Right, Bastian? This looks okay here. Now, the thing about Spot is that it's a pretty pricey stock. So you're going to want to price it out, see what your max risk is, maybe throw in a one lot or something we can talk about if that is too much risk. I would you could put on like a half lot. But yeah, Bastian, it looks all right. It's not like the best looking, but it definitely would qualify for me. Seeing some big moves in Q2, not the biggest, but got a pretty big range of moves here. Might want to be aware of that. And we can chat about putting on a half lot if you need to. Right? Any of the guys in the group can help with that towards the end of the day. Eric saying you're going to hold that hostage. Thanks, man. I appreciate it. I really thought this was like a give and take scenario where we alpha for everyone, right? We have a small enough team we can still do that. We just need maybe when the team gets a bit bigger, we'll keep some of the alpha a little more secret. But for now, we can share. Okay, guys, that is going to do it for today's live. All right. I'm really sad about that first one, that it's so small. Where is it? What was it? Siri. Runcorn. You're getting a DM from me right after this live, man. Exactly, Micah. That is my free alpha. I actually think 79 a month is negative EV for me, given the time and effort. All right, guys. We'll see you in the group. And if you're new to the stream, if you happen to just join, just so you know, PA has a free trial. So you can join the community, get your own terminal, go through all the education. It's a 2-week free trial. You just go to predictingalpha.com. You can sign up there. So, see you guys in the group. Have a great day, everyone.